Are you willing to get involved militarily to defend Taiwan if it comes to that?
Yes.
You are.
That's a commitment we made. That's a commitment we made. We are not, look, here's the situation.
Clean up this mess!
All right. Today is Tuesday, the 24th of May, and this is a recap of the stock market activities today. Folks, I got a good one for you tonight, and apologies for the absence yesterday. I was in a special assignment in Davos to document the updates on the Own Nothing and Be Happy agenda, but most importantly, documenting the satanic rituals over there. Oh, the human sacrifice is my favorite part, although drinking the blood thing is a close one. Anyways, now we're back, and guess what? The stock market is down again. Lots of pain out there, and a lot of you are giving up. You're messaging me, I'm done, bro, this is it, the stock market is going down to zero, I'm selling everything, yada, yada, yada. And I say, you know what? If you've been having a bad day, rest assured knowing that it's not really that bad. Because, look at this poor so-and-so, for example. The headline reads, Russia was invading, so a Ukrainian converted his life savings of $10,500 into the crypto token Terra. Then the token crashed. Uh-oh. You want to talk about a double whammy? Here it is. The guy lost his country and his savings. A hole in the tulip that crashed by 99.9%. What was it, last week? The week before that? I don't know. A better investment would have been buying the Russian ruble on the dip. Is that too soon? Is that too much? Too dark for you? How about this one? Maybe a little brighter. If you thought your day is bad, think about this. You could be a Hyundai owner, wake up in the morning, you go to your car, get in, safety first, you buckle up your seatbelts, and boom. The car explodes. Or your seatbelts explode, excuse me. The car explodes if you have a lot of enemies. But anyways, let's move on here because we got a lot to talk about, a lot to catch up on. So here it is, in focus tonight. More Biden debacles. Where is the end? And then we have a warning from Snapchat that the recession is coming 1,000,000%. And lastly, the word on the street. We start with this. Of course, you saw the intro. Your boy Joey B slipped again and almost declared war on China. Just a little accident, no biggie here. We're at war with Russia. Now we can bring in China. We can take them both, right? No problem here. And by the way, now that you know for sure we are in a proxy war with Russia, and we're about to be at war with China now, you know, World War III, the question is, did we vote on that? Did we support any of that? Did your beloved senile leaders come to you and say, hey, here's the deal. We're going to be at proxy war with Russia, or we're going to have to spend $15 billion a month on that war, but it's worth it because A, B, and C. Did we get any of that? Or did your dear beloved senile leaders just did whatever they think is right? No permission, no voting, no consensus, nothing at all. But perhaps they got the consensus and the blessings from Davos. That's where the agenda is set, of course. For example, today we got commentary from legendary trader George Soros, who says that the invasion of Ukraine is the end of civilization. What the hell are you smoking? 3 months ago, most Americans didn't even know what Ukraine is. Matter of fact, most Americans cannot even point the United States of America in a map. So, but anyways, here's George Soros' commentary.
The invasion of Ukraine didn't come out of the blue. The world has been increasingly engaged in a struggle between two systems of governance that are diametrically opposed to each other: open society and closed society. Let me define the difference as simply as I can. In an open society, the rule of the state is to protect the freedom of the individual. In a closed society, the role of the individual is to serve the rulers of the state.
It sounds like the U.S. is a closed society, isn't it, Mr. Soros? We have to obey the rulers. Otherwise, God forbid, the Ministry of Disinformation might ban you from talking at all. Hello? Is this an open society? Anyways, I was watching this report from ABC, and it's absolutely mind-boggling. The level of propaganda and misinformation coming from ABC, by the way. You know, the verified news source. Here are some snippets from that report.
Coverage right now of the president's trip to Asia, as well as the latest in Ukraine. So joining us now is ABC News political reporter Brittany Shepard from Washington, D.C., and ABC News foreign correspondent Tom Sufi-Burge. He's in Kyiv. So, Brittany, let me begin with you on Biden's comments on Taiwan. Yeah, obviously, the White House is trying to clean it up because they say we aren't really changing U.S. policy. But I'm wondering, given what's happening in Ukraine and the president's response to that and what it might say about authoritarian regimes' eagerness to test the United States' resolve, might it be intentional on Biden's part? And if not, what's the point?
And I think that there's some critical thinking here done by Biden. Say, if I come out strong against China, if I show that we're willing to not only get up to the line, but put boots on the ground, or as the White House staffer has been saying for the past couple of hours, just providing military help by weapons, that the United States is unafraid to look China in the eye and say, we are here. It's no longer the America First policy that President Trump pushed, that America First was America alone. Now America First means America together, at least if you're Joe Biden.
Listen to how they talk. America's not alone anymore. What an accomplishment. I don't know, were we alone before? Did we make new friends or something? And who gives a shit anyways? Your job is here, the country that you're in right now, the people that you're serving, the people who voted for you. And these people are suffering from insane inflation and a crumbling economy. But hey, at least we made new friends in the world. Come on, man. Meanwhile, older Ohioans are skipping meals. Yep, we got a hunger crisis here in this country. Let's continue with the report and more Biden debacles, this time regarding India and the hunger crisis. Take a listen.
So we heard a little bit about this trade and economic plan in Brit's package, and we're going to hear President Biden pushing his allies in the Quad to be hard against Vladimir Putin and come out in support of Ukraine, especially pressing India's PM Modi on his relationship with Putin and all of the ancillary damage that this war in Ukraine has caused. It's not just human life and military life, but it's also a strain on human hunger. There's a humanitarian world hunger crisis that the White House says that they will definitely be pushing this food shortage. You know, Ukraine is the breadbasket of the world, and India is the second largest grain exporter, and India has banned all domestic exports on grain. That means all the bread they're making is not leaving India.
And here's the solution, of course. We're bribing India with $4 billion now to please release some wheat and whatever grains you want. Otherwise, we're going to have a global famine. So this is the strategy right now. Keep begging, keep bribing. When it comes to the begging tour, here it is. Biden says reducing tariffs on China is under consideration. Ways asking OPEC to pump more oil. So here it is once again. With one side of the mouth, Biden says, we're going to go at war with China if they touch Taiwan, but we're also considering removing the tariffs because we're too desperate and inflation is too high. Which one is it? And then, of course, begging OPEC for more and more and more, and OPEC already said, get lost, we're not pumping more. When you got China slowing down, when you got recessionary warnings all over the place, we're not pumping more. Good luck. But it gets even better. In this report, they talk about Starbucks and the exit of that company from Russia. Take a listen.
I want to turn to inside Russia. Starbucks announcing today that it's following other big international names pulling out of Russia altogether. Is that a big deal?
I think it is. I think every single big name, Starbucks is a big name, that pulls out of Russia. It affects Russians' lives. It might affect a proportion of the population, namely urbanites, people in the cities, people with at least a degree of money. It might not hit poor rural communities. But the Ukrainians say this does matter, and Zelensky was pitching to the global business elite in the Swiss resort of Davos today, their annual gathering, and his pitch was really about this, that he wants more Western businesses to shut the door on Russia, to increase the economic pain.
Wait a minute now. So our businesses are now taking orders from a foreign leader? And while we have this inflation and this insane economic collapse, but we were winning, folks. The Russians are not going to taste Starbucks anymore. They're not going to taste McDonald's $2 anymore. In your face, Putin, we're winning. And listen to the last bit here. I mean, it's absolutely mind-boggling. Take a listen.
And he wants Western leaders to close the loopholes on sanctions. No sanctions are perfect, I think it's fair to say. He wants them to be tightened up. He wants the pressure on the Putin regime to be cranked up so that it has some kind of impact, not only on funding the war, but politically as well in Moscow too.
Because right now, not only is Russia surviving, the ruble's hit a 4-year high recently. And so it looks like there may be more room for sanctions, at least according to Zelensky there.
Did you even listen to yourself? You just said the ruble hit another high despite the sanctions. And that is yet another proof that there is more room for more sanctions? What the hell is wrong with these people? Doing the same thing, expecting different results, is the definition of insanity. And by the way, while we're at it, here's your Sticking It to Putin, brah update. Sticking it to Putin, brah. So how's sticking it to Putin going on right now? Here it is. Russian ruble leaps to near 7-year high versus the euro. The British pound is trash. It is crashing by the day. So is the euro. And the dollar is obsolete if it wasn't for the hegemony and the weakness of other currencies. Meanwhile, the ruble is hitting new highs. Do we stop at some point and think? What are we doing here? We're hurting our own economies. We're destroying our own economies. We're not achieving anything at all. What's going on here, folks? Because here's what winning looks like. Right now, we're paying the highest prices at the pump ever. $4.06 average. In California, it's over $6 average. And it goes on and on. And oh, by the way, your utility bills, those are getting higher. Much higher. U.S. households are about to get some of the highest power bills they have ever seen. This is what winning looks like. This is what sticking it to Putin, brah, looks like. We're losing, folks. We're getting humiliated here. We're paying the price. Regular folks, not the elites, not the oligarchs. And the polls reflect exactly that. For example, 66% of adults under 30 years old, these are the Gen Zers, think Biden is too slow to react to important things. 66%. 60% among Hispanic Americans, and a stunning 49% among Black Americans. We have never seen such numbers from these groups before. The percentage of Americans saying things in America going badly is now sitting at a stunning 74%. And the percentage of Americans saying the economy is bad is now at 69%. Things are falling apart. The economy is suffering. And this is a good segue to the next subject of Snapchat, because the company of Snapchat provided us with yet another evidence that a recession is coming. We got bad news last week from Walmart and Target and the consumer staples, the defensives, and a massive crash took place in the stock market in these names. Now we're getting another sector of the economy, social media, and these technology companies who are saying yes. What you heard from Walmart, what you heard from Target and the likes is actually true. It's happening. Companies are struggling with inflation. They can no longer pass the inflation cost all the way down to the end consumer because the end consumer is switching their habits. They have to spend more at the gas pump, at the grocery store, paying for rent, for utility bills, and they cannot spend on restaurants, on services, and goods anymore. And it is hurting corporate America big time, which will eventually lead to more layoffs, and the pain will be felt in Main Street. Yesterday, we got the news. Snapchat stock went down by more than 25% after hours when the CEO came out and said, forget about the guideline that we gave you last time around. We're not going to make it. Tamper your expectations because we're going to miss on earnings and revenues. And if you thought the stock losing 25% of its value after hours yesterday is bad, here's the update. Snapchat is down 43% today. In a single day, down 43%, losing almost half of its entire value. The worst day ever for Snapchat. And it's not just Snapchat. The stocks of Meta, Amazon, Pinterest, all of the social media companies, and even the travel companies, cruises, hotels, casinos, got absolutely whacked today. Why? Because we now have concrete, conclusive evidence that a recession is coming, that the consumer is weakening by the day. Things are moving rapidly, and we're going to hit a recession very very soon. When it comes to Snapchat, the company will also slow hiring, Chief Executive Officer Ivan Spiegel said in a note to staff. Like many other companies, we continue to face rising inflation and interest rates, supply chain shortages, and labor disruptions. Wait a minute, Snapchat has supply chain and labor? What is he talking about? Anyways, platform policy changes, the impact of the war in Ukraine, and more, he wrote in a memo obtained by Bloomberg. But here's the most important part. The macroeconomic environment has deteriorated further and faster than anticipated, Snap said in a filing. As a result, we believe it is likely that we will report revenue and adjusted EBITDA below the low end of our Q2 2022 guidance range. And of course, the founders of Snapchat, Ivan Spiegel and Bobby Murphy, lost about $3 billion in a single day. But don't feel bad for them because we covered the insider sales, by the way, in another video titled Ponzi. Go watch that one. But these two guys dumped hundreds of millions of dollars worth of stock last year at the top. So don't feel bad for them. They don't really give a shit. It's just paper money. They already have hundreds of millions of dollars. But who ends up holding the bag? The retail mom and pops, the retirees, the regular Jane and Joes. Those are the ones who suffer when these crashes happen. And it's not just Snapchat, by the way. We're getting it from everywhere. Every company that reports is now showing the consumer slowing down dramatically. For example, Abercrombie, down 30% today. Why? Because they cannot keep up with the cost of inflation, and they cannot continue to pass that cost all the way to the end consumer without denting demand. So now companies have to eat the bag. Companies have to accept lower margins. This is the destructive nature of inflation. And when you leave inflation unchecked, just like the Federal Reserve did, led by the genius Jerome Powell, this happens. Even Best Buy came out today cutting profits forecasts because inflation is hitting big time. Macro conditions worsened since we provided our guidance in early March, which resulted in our sales being slightly lower than our expectations. Sounds familiar? Sounds like a theme now? Everybody says the macro conditions are getting worse by the day. Continuing, those trends have continued into Q2, and as a result, we are revising our sales and profitability expectations for the year, said CEO Corey Barry of Best Buy. And again, why is the consumer weakening? Because they have to pay more at the pump, more at the grocery store, more in rent, more in utilities. 70% of American adults view inflation as a very large problem in the United States right now. Not the thing, not climate change, not the war in Ukraine, not farts in a jar. Inflation is number one. And now, 77% of investment fund managers see an economic storm of slowing growth and high inflation taking hold over the next year. Uh-oh. This means stagflation. The recession is going to happen one way or the other. It all depends on when the Fed is going to respond. If they respond right now, we get the recession right away. If they delay, hoping that inflation is going to go down on its own, it's not. We're going to have stagflation, prolonged stagflation. And at some point, the Fed will have to slam their foot in the brakes to slow down inflation. Once they do that, it's not going to be a recession. It's going to be a depression. So they better act right now. Recession, believe it or not, is the best case scenario right now. Because tightening right now, while the economy still has some cushion, and that cushion is the low unemployment rate, the magnitude of the hit will be muffed. Yes, it will produce a recession, but that recession could last 6 months, a year, and then we're going to be able to rebuild again. But if the Fed waits till the economy falls apart and then they get surprised by inflation, hey, inflation did not go down, yet the economy went down. How do we slow down inflation? Well, we have to increase rates even further and tighten even more. But when they do that, the economy will already be in shambles. So that recession becomes a depression. See, a lot of genius economists cannot differentiate between growth and inflation. They think both are the same creature. Growth and inflation are the same. That cannot even be any further than the truth, because they say, oh, growth is slowing down right now. Look at what's going on at Best Buy. Look at what's going on at Walmart. Look at what's going on from the information that we got today. For example, new home sales plunging down over 16% month over month, ladies and gentlemen. So the growth in the pace of economic activities in the housing market, for example, is down, yet prices continue to linger higher. See what's going on here? Growth goes down. That doesn't mean necessarily that inflation is going to go down. Two different animals, growth and inflation. Inflation doesn't go down on its own. It goes down when the monetary policy responds. So for now, we're having stagflation in the housing market. No buyers, no economic activities of new home sales, yet we're seeing prices still lingering at all-time highs. Look, for example, at the global flash PMI that we got today. It is collapsing. This is not a look of a growing economy. This is a look of a collapsing economy. And here was the commentary from Chris Williamson. The early survey data for May indicate that the recent economic growth spurt has lost further momentum. Growth has slowed since peaking in March. Pay attention now. Growth is peaking, not inflation. Most notably in the services sector, as pent-up demand following the reopening of the economy after the Pokemon wave shows signs of waning. Uh-oh. All of you who are placing your hopes on the reopening of the economy, good luck. Companies report that demand is coming under pressure from concerns over the cost of living, higher interest rates, and a broader economic slowdown. Manufacturers in particular also report that capacity continues to be constrained by supply shortages, though these bottlenecks showed further encouraging signs of easing. Despite all of the headwinds facing businesses, the survey data remain indicative of the economy growing at an annualized rate of 2%, which is also supporting stronger payroll growth. However, cost pressures have risen to a new survey high, which alongside the encouraging output and employment numbers will fuel further speculation about the need for further aggressive rate hikes. Bingo. You see, now the economy still has some cushion. The Fed must act now, but unfortunately the Fed still believes that inflation is transitory. It's going to go down on its own. Now we're hearing more voices. I heard Professor Siegel, the good professor from Wharton, who has a record, by the way, of being wrong on pretty much everything from the dot-com bubble to 2007, 2008 crash, when he said that he doesn't see a crash, and then we got the biggest crash since the Great Depression. And now he says, oh, the economy is already slowing down. The stock market is down big. So the Fed needs to be careful by not being too hawkish. What the hell are you people talking about? Inflation is not going to go down on its own. Inflation might slow down, inflation might cool, but inflation will rise again, absent of action from the Federal Reserve. If history taught us anything, it taught us that inflation doesn't go down on its own without action from the monetary policy. So the Fed could say, okay, we're going to listen to Siegel and the likes and say we're not going to do more interest rate hikes after the 50 basis points we're going to do in the next meeting. Watch how inflation comes back with such vigor. But at that time, in the fourth quarter, when the Fed finally realizes that they have to increase interest rates dramatically, not just to the so-called neutral rate of 2.5%, 3.5%, but perhaps way more than that, 5.5%, 6.5%. When they realize that that's the only way out of this inflation, the economy will be already in a recession on its own. And the action by the Fed will lead us into a massive recession, if not a depression. The time for action is now, because look at this. Bank of America raises hourly minimum wage to $22 an hour. Inflation is not going to stop. Inflation is here, and it's not going away. Another indicator is the Philly Fed Manufacturing Index. The headline reading was the lowest since the thing began, which is indicative of slowing down the pace of economic growth. Here are the details. New orders, almost 50% of those responding to the survey said there is no change. So new orders are not going down, they're not going higher either. When we look at unfulfilled orders, 63% say no change. So for now, we're seeing the pace of economic activity is stagnating, but it's not falling apart yet. Keyword yet. And hence the cushion for the Fed to act. On the other hand, prices paid, 81% say that increased from April and May. Prices received, 52% say that went higher month over month. So again, inflation continues to go higher. Pace of economic activity slowing down, stagnating, plateauing, and soon enough, it's going to start to take a nosedive. And St. Louis Fed President, what is he saying now? He's saying that retailers who don't understand that consumers are stretched thin by inflation are going to get punched in the face. He's talking about what? He's talking about price gouging. Mr. Bullard, we looked at the earnings. If anything, the companies are not doing enough price gouging. If anything, companies are actually getting crushed by the cost of inflation. They're not really able to pass the cost of inflation down to the end consumer anymore, at least in the case of Walmart and Target, because if they do, they're already noticing that demand is waning down on its own. If they increase prices, they're going to crush that demand even more. The core problem here is inflation. But here comes the stumbling by the Fed presidents and officials with the confusing messages. No clear policy at all. We have Atlanta Fed Boystick now suggesting pausing rate hikes in September to assess the impacts. Powell says he wants to be Volcker and he will do whatever it needs to do. Then he says, oh, but we're not doing 75 basis points. Then Mr. comes out and says, oh, the stock market is upset that we're not doing 75 basis points, then we're doing 75 basis points. Then comes Boystick after the stock market goes down even further and says, okay, I guess the stock market doesn't want excessive rate hikes, so we're not going to do that after September. Which one is it? Make up your mind, for the love of God. Give us some clarity. The stock market doesn't give a rat's ass whether you're going to increase rates or not. The stock market wants clarity. If we have a clear path in increasing interest rates, in normalizing the monetary policy, then the stock market will adjust its expectations easily, and we're not going to see these excessive moves to the downside. Folks, we're talking about stocks losing 50% in a single day. But rest assured, Fed Bernanke, remember the ex-printer-in-chief, he says the Fed will succeed in bringing inflation down over the next couple of years. Oh, it's the next couple of years now? What happened to transitory? What happened to by 2023? So it goes from transitory to 2022 to 2023 to a couple of years to infinity and beyond. Next, let's talk about a segment we call Word on the Street. As you can see, the S&P 500 is on the brink of a bear market. We already know that we are in a bear market regardless. The Nasdaq is. Soon enough, the S&P will. But look at this. The forward PE ratios are now back at the mean. So we got the reversion to the mean in the forward PEs. The problem is when you factor in peak earnings, peak corporate earnings, then the forward PEs actually go higher from the level of 16.7 right now in this example to, let's say, 18, if not 20. So we have more haircuts to come. This is deceiving in many ways because it doesn't factor in peak corporate earnings. But rest assured, let's talk about the good news first. Yesterday, we got gangster Jamie Dimon from the laundromat of JP Morgan Chase, and he came out and said that the U.S. economy remains strong and potential obstacles to growth are not set in stone. And I was watching CNBC today, and there was this lady, I forgot her name, but she kept saying, oh, the economy's not doing bad. Forget about Snapchat. I'm not going to make decisions based on Snapchat or Walmart or Target or Abercrombie or the dozen other companies that reported before that. I'm going to make my decisions based on Jamie Dimon. Jamie Dimon said the economy is fine. Yeah, that's the same Jamie Dimon, by the way, who just a few days ago, who said the Cold War is back and a recession is a real possibility. Now he says it's not set in stone. Okay, this is the same Jamie Dimon, by the way, last year who said that he sees a boom coming in the economy. Maybe he meant kaboom in the economy, because that's what's happening. Here's another CEO, another bankster from Bank of America this time around, who says nothing will slow down U.S. consumers from spending money. How about running out of cash? How about swiping those credit cards up and down, up and down, up and down until they're maxed? How about when the consumer, the strong consumer, loses his or her job and interest rates continue to go higher, and now they got mortgages they cannot afford, and oh, by the way, they maxed out their credit cards and interest rates continue to move higher. How about that, Mr. Whatever your name is? But regarding the stock market, here's the good news. The technician who called the 2020 market bottom says a shocking rally, quote unquote, is in store. What is he talking about? He's talking about this. These are the DeMark folks. It's another voodoo science between you and I. But anyways, the DeMark folks say we're waiting for two closes on the S&P 500 below 11, which is the previous low. So if we have two closings below that number, that's going to be a bear trap. What's going to happen is the stock market is going to blast higher, and it's going to go all the way back to the 200 days moving average. And then we're all going to wake up and realize that it was a dream. But anyways, here's another one. Barron says stocks are ready for a bounce higher after the S&P 500 rallies out of a bear market. Another one. A bear market rally could be lurking, but investors should sell any rips, says Bank of America. And of course, a lot of folks are waiting for VIX 40. That's what everybody's waiting for. When the VIX hits 40, that's the bottom, and we start buying again. Let me tell you something right now. VIX 40 is not going to happen, at least not right now. Maybe it's going to happen. Nothing is set in stone, as Jamie Dimon would say. But in my opinion, at least, when everybody's expecting VIX 40, the market is going to bottom before VIX 40. We're going to see the summer rally happening. Everybody's going to get sucked in again, saying this is it, the bottom is here, the stock market is fine, the economy is getting better, yada, yada, yada. And then VIX 40 is going to happen. Not just VIX 40, by the way, VIX 60 plus. Going to happen in the fourth quarter of this year, September and beyond, when things start to fall apart again. So here's the segue from the glass half full, you know, the bounces, the bear market rallies, etc., to the glass half empty. The godfather of chart analysis says, Robinhood investors are going to get their heads handed to them as stocks on the verge of a bear market. And I say to the godfather of chart analysis, the Robinhoodians already got their heads handed to them. And now they're all working at McDonald's. We also have Ray Dalio, who says cash is still trash, but stocks are trashier. This is the same guy, by the way, who just bought AMC after the stock already crashed, and it continues to crash. So take whatever he says with a grain of salt. Although I like Dalio, he's a nice guy. And then we have Scott Minard, who says Bitcoin, that's your tulip investment, could fall to 8,000. A more than 70% plunge. And this is according to Guggenheim, Scott Minard. Now again, take whatever he says with a grain of salt, because his brightest idea is, if you got $10,000 right now, he says buy real estate. What real estate? With $10,000. 10,000 grand can get you an empty Amazon box on the street, but that's about it. Or he says put your money in art. We're talking Picasso here, we're talking NFTs, we're talking apes. What are we talking about here? Anyways, we have economist David Rosenberg, who I like, but he's been dead wrong for pretty much the entirety of this bubble, predicts the S&P 500 will crash further 17% and says we are currently reliving the summer of 2008. Now, Mr. Rosenberg is right, because history repeats itself, and this is deja vu all over again. History repeats itself. We're just new players in the same old game, and we get dumber and dumber as the time passes. Now, Mr. Rosenberg was wrong because he kept saying deflation, deflation, deflation. All we got is inflation, inflation, inflation. When it comes to the risk on, risk off, believe it or not, the NASDAQ might be down 30% from the top, but it is still in risk on. Soon enough, it could dip below 50 and it becomes risk off. That could be a sign that you should buy the NASDAQ at that time. The US dollar, for example, reached almost 100% risk on, and after that, it topped, and now it's going down. Gold went down all the way to zero, risk off, and now gold is bouncing and moving perhaps closer to risk on. So hey, Maverick, how bad is it going to get? Just tell us. Well, I'm not going to tell you, but here's the experts. According to the survey, the majority expect the S&P 500 to go down 10% or more from this point. So here it is, according to the survey, we're going to go down to around 3,500 in the S&P, which by the way correlates with the 200 weeks moving average, which we talked about before in this program. That should be strong support when it happens. I'm just not sure it's going to happen in one shot. I think we could have a summer rally, a suckers rally, and then we go down in the fourth quarter to 3,500 and beyond. And here was Snake Bill Ackman came out today and said a more aggressive Fed or market collapse are the only ways to stop this inflation. And he's not wrong, folks. The Fed needs to come out decisive. They need to bring the Fed funds rate to what they deem as neutral immediately. So if Jerome Powell says 2.5%, do that in the next meeting. We're now at 1% in the Fed funds rate. Add another 1.5 points. Get it to neutral, and then we'll take it from there. You think Jerome is going to do that? Of course not. He's going to do the 25 basis points. He's going to do 50 max, because once again, the Fed remains obsessed with the stock market. I mean, with this kind of obsession, I'm surprised the stock market did not file a restraining order against the Fed already. But here's the point that supports Ackman and those of us who say the Fed needs to get really aggressive right now because A, you still have the cushion, B, excess liquidity is still in the system, so inflation is not going to go anywhere. For example, the Fed's reverse repo facility reached over $2 trillion for the first time ever. We know back in 2018, when everybody stampeded in the reverse repo facility, a disaster was bound to happen. This could happen again. An accident could happen again, and that could crush the stock market and everything. But this is yet another indicator that we have plenty of liquidity in the system, excess liquidity, that needs to be sucked away. And that's not going to happen via the reverse repo. I know Vacuum Man, Jerome Powell, believes that if he uses the reverse repo facility and he sucks all of that liquidity out of the system, that'll do it, and inflation is going to go down on its own. Watch out here. That is excess liquidity. Whether it's in the banks, whether it is in reverse repo, whether it is in real estate, in stocks, it doesn't matter. That liquidity is still floating in the system, producing more and more inflation. Even JP Dimon, the Landromat, chief executive, whatever the hell he is, said at the firm Investors Day that the Fed almost has to do so-called quantitative tightening since there is too much liquidity out there. Again, this is the same Jamie Dimon who said nothing is set in stone. the economy is still strong, yet with the same mouth he says the Fed needs to do a lot of tightening because there is too much liquidity out there. That produces a recession, Mr. Diamond. Whether you're putting a lipstick on a pig or not, whether you're sugarcoating or not, the facts are the facts. Inflation is not going to go down without action by the Fed. That action will produce a recession. If it happens now, if it happens later, it will produce a prolonged recession, if not a depression. But hey, even if the economy slips into a depression, we can just send it to a therapist. And then they can prescribe all kind of drugs, big pharma drugs, and relieve the economy from its depression state. Take a Xanax or something. That's the real solution to the economic crisis. But anyhow, we're going to move on to cover the stock market for you, and we start with the performance of indices today. And here we go. The Dow Industrial Average closing in the green by 48.38 points, or a gain of 0.15%. The Nasdaq, on the other hand, down by 270.83 points, or a decline of 2.35%. Likewise, the S&P 500 down in the red by 32.27 points, or a decline of 0.81%. The sector's performances led by number 1, utilities, capturing the gold medal, and number 2 for the silver, defensives, number 3 for the bronze, REITs. Meanwhile, the laggards of the day led by communication services, cyclicals, and technology. The advance to decline ratios, NYSE 29% advancing versus 68% declining. The Nasdaq 21% advancing versus 75% declining. And look at that, we have 362 new 52-week lows in the Nasdaq. Among them, of course, Snapchat, Meta, and many of the social media names. Moving on to commodities, muted action in crude, nothing is moving here one way or the other. Brent pretty much flat, the WTI down slightly. Likewise, a modest down day for gasoline. Anything is a relief at this point. It was almost $4 a few days ago. Now we're back at around 3.78. We'll take whatever we get. On the other hand, heating oil closing the day with gains over half a percentage point. And then we have natural gas, the winner of the day in energy, closing the day with gains of over 1.5%. Of course, we continue to follow up on the story of natural gas, specifically in European countries, in this case Germany. Germany is going to be in a world of trouble if the winter season arrives while they cannot secure alternative resources of natural gas from Russia. Therefore, Chancellor Scholz was in Africa and Senegal in particular. He is in an African tour right now begging for natural gas. How ironic, of course. And now, here's the win for the green energy cult. You know, saving the planet. How's saving the planet going on, by the way, when Germany's now being pushed to reactivate coal and oil plants if Russia cuts off gas? How is decommissioning nuclear plants working out right now? I mean, Germany had, with nuclear plants, independence, clean energy, and think about it, even time travel.
Du solltest nicht so lange im Regen stehen.
Warum?
Na, weil der sauer ist. Chernobyl?
Anyways, back to the futures. Softs, we have declines, modest declines below 1% for coffee, cotton, and cocoa futures. Sugar was flat, yet we have gains. OJ was up over 0.75% today. And then we have the rebounder of the day, lumber, closing the day with gains of a little over 2% at the magic number of 666. Then we have metals. The dollar is down. Therefore, we're seeing gold and silver up. Silver, in this case, is the outperformer, gaining almost 1.75%. We also have gains for palladium, a little over 1.25%. Yet we have declines, modest ones, below 1% for both copper and platinum. When we talk about meats, we have flattish activities for live cattle futures. On the other hand, gains of over 1.5% for feeder cattle futures. Yet on the other hand, the new big tech lean hogs getting slaughtered today, down almost 2% after an impressive rally. Grains, we have losses led by wheat, down almost 3% today. Likewise, corn, down almost 2%. We have modest declines for rough rice and soybean oil. By the way, soybean oil is reaching a decade high, and soon enough it might reach all-time highs. We have flattish activities for oats and soybeans, yet we have noticeable gains of almost 1% apiece for both soybean meal and canola. Moving on to the big casino, the options market. What's going on here? Notice the volume. It is still down. We're not seeing the participation from retail or institutionals, for that matter, buying calls. And if nobody's going to buy calls, all of these rebounds are not going to be sustainable. We need to see higher options volume specifically for calls. Now, call options buyers are waiting for more confirmations. They've been duped before. We've had many false attempts of a rally and a rebound, multiple pies have been eaten, and now folks are waiting for other folks to start buying first. You go first, get us above certain levels of resistance, and then we're going to buy calls. This is the glass half full explanation. The glass half empty explanation is the following. The retail crowd already ran out of ammo. No more money. They already got crushed. Nobody's going to rescue this market from collapse because the retail is out of money. They cannot buy options. They cannot buy stocks. They cannot buy anything at all. Now, I think the answer is a combination of both because, yes, we're seeing a lot of retail getting absolutely annihilated out of the stock market. Their stocks are down 70, 80, 90%. Yet we're seeing retail still buying puts. So there is a chunk of retail who are still buying puts and scoring big. When are they going to switch sides and start buying calls? That is an important transition to watch out for. Regardless, Apple came up number one at around 925,000 contracts. About 47.5% of those were calls. The number two, Bank of America, BAC, at around 500,000 contracts traded for the name today. About 62% of those were calls. Number three, Tesla, at around 425,000 contracts. About 44% of those were calls. Here are the unusual activities that took place in the options market today. We start with the ticker SLB for Schlumberger. Somebody's buying calls here, betting that oil and gas names are going to continue to move higher. There is another leg higher. In this case, they're betting on SLB by buying the 47 calls for the expiration date, June 17th, with the expectations the name could move higher by more than 6.5% by then. They paid around $1 a piece to enter this trade, all in all spending around $5 million. What about the ticker PFE Pfizer? Somebody's buying puts here. The 50 puts for the expiration date, July 15th, with expectations that Pfizer could go down by more than 6.5% by then. They paid around $1 a piece to enter this trade, all in all spending around $1.3 million. And then we have the triple Qs, the NASDAQ. Watch out for this one. The bears are getting emboldened. They think that after Snapchat, we're going to see more declines. But here we have a trader saying, watch out, there is a rebound coming, at least in the NASDAQ. They're buying the 323 calls with the expiration date, August 19th. With expectations that the NASDAQ could gain more than 12% by then. They paid around $4.30 a piece to enter this trade, all in all spending around $3.5 million. And then we have the ticker SQ for Square, aka Block. They're also betting for a rebound in this name by buying the $80 calls for the expiration date, June 17th, with expectations the Block could rebound higher by more than 5.5% by then. They paid around $5.30 a piece to enter this trade, all in all spending around $4.2 million. And then we have the ticker GOLD, Gold, for Barrick Gold. Now, yesterday I did buy the dip in gold miners because the dollar was below 103, but I bought in New Mount Gold, which is the stock that I own for now, in WPM Wheaton Precious Metals. But here we have somebody betting that I'm going to eat a massive pie in the face because they're buying the $20 puts on Barrick Gold for the expiration date, August 19th, with expectations that the name could go down by more than 6% by then. They paid around $1 a piece to enter this trade, all in all spending around $600,000. Lastly, at the bottom of the table, what about the ticker EA, Electronic Arts? It has been an outperformer so far, and the reason is the M&A rumors. And therefore, somebody's betting for more gains to come. In this case, they're buying the 150 calls for the expiration date, June 3rd, with expectations that the name could move higher by more than 10% by then. They paid around $1 a piece to enter this trade, all in all spending around $500,000. Moving on to the heat map analysis. Again, the outperformers are the defensives, be it Big Pharma. We talked about the strength of Big Pharma in the last video. We're also seeing green activities in where? The defense contractors, Lockheed, Raytheon, General Dynamics, etc. And then we're seeing utilities, REITs, and gold moving higher in materials. And then the defensives are also rebounding. Walmart, Procter & Gamble, but specifically the consumer brands. Now, instead of buying the dip in Walmart, you want to buy the dip in the strong if you must stick with defensives. And the strong was Kellogg's, GIS, General Mills, all of these names were in a bullish trend, and then came Walmart and Target and impacted them negatively. Likewise, the value names such as Verizon, AT&T, and Communication Services outperforming, McDonald's and cyclicals. We also have the value giants, IBM and Cisco, in technology. Financials, it is a mixed picture. The credit cards are down, Visa, MasterCard, Amex. The big banks, JP Morgan is moving higher on the heels of JP, whatever his name is, Diamond, pumping. Besides besides that, the majority are down. So again, if the risk-off sentiment continues, then we're going to see big pharma, utilities, REITs, the defense contractors, certain defensive names, and perhaps gold, depending on the dollar, continuing to outperform. But if we have a bottom in technology, we're going to see a rotation out of these defensives, specifically big pharma, utilities, and REITs, all the way back to technology. But a lot has to happen before that takes place. Market participants are waiting for a lot of confirmations before they dip their toes in technology again. Now, here are some corporate news for you. We talked about Starbucks exiting Russia and losing 130 cafes. Now, Starbucks' loss is somebody else's gain, and the assumption is it's going to be a Russian or a Chinese company. But again, Starbucks has a lot of headwinds from the unionization in this country, wage inflation, materials inflation, and then they have the exit from Russia, perhaps a backlash in China. All of that's going to add up. But if you're looking for a retailer or store you want to invest in, well, according to MarketWatch, millennial homeowners prefer to do renovations, the DIY, which could be favorable for Home Depot and Lowe's. Too late. The renovation's already been done in 2020, 2021. Now comes the phase of losing homes. As people lose jobs and they're stuck with mortgages they cannot afford, they're going to start dumping these houses for pennies on the dollar. A better investment would be betting on vans. That's the new American dream, of course, or betting on paper boxes, because if you don't have a home, you can buy a big box, put that in your head, sleep on the street, and call that a home. Anyways, we have Google, Alphabet. Well, YouTube announced that they removed 70,000 videos and 9,000 channels related to the Ukraine war, spreading misinformation, quote unquote. Again, do we have free speech or not? You don't get to decide what misinformation is. The audience decides. That's how freedom is supposed to be. But now we don't have freedom. We have a deep state globalist oligarchy. They control all the media. They want you to be exposed to information that they deem appropriate and true. Anything else, you're not even allowed to be exposed to, and decide on your own. And now we have Meta, Facebook, is pledging to provide researchers with more information on the targeting of social issues, electoral, and political ads on Facebook and Instagram. In other words, Meta is going to sell your personal data to the highest bidder. They've already been doing that, but this is a confirmation. And lastly, we have Beyond Meat. Beyond Meat is hiring Kim Kardashian as their chief taste consultant, because Kim Kardashian has tasted a lot of meat in her life, real and fake, and she knows what kind of sausages taste good or not. So again, if you're going to consume Beyond Meat, rest assured that Kim K is going to do the tasting for you. Now, can I get a monkeypox from that? Anyways, moving on to the heat map for the ETFs. This is a daily heat map, and again, pain across the board for the retailers, for the cyclicals, for technology, for biotech. Value is outperforming growth. The VTV versus the VUG, the IWD versus the IWF. You can see it in the ETFs for individual sectors. For example, value ETFs such as the XLU, XLP, the IYR outperforming today. So did the inverse indices, the SQQs, the SPXS. And in commodities, gold outperforming GDX, GLD, SLV for silver. And then we have international markets, down for the most part, led by China. We still don't have good news regarding the Shanghai lockdowns, or we're getting more bad news about the delisting of Didi and perhaps many other Chinese companies, and therefore the FXY, the MCHI down big today. Let's move on to charts, and we start with SPY, the S&P 500 30 minutes chart. Monday, we saw a gap higher, and the chart stopped at 398 as resistance, could not make it above that, but it consolidated in a bull flag pattern. Now again, in a market like this, the technicals matter, but so do the fundamentals. So if we get bad news after hours that Snapchat is confirming a recession, and we see technology and social media stocks getting shot, the technicals are not going to work anyways. And therefore, we get a gap down. Now we open the gap down, and the chart managed to close the gap below that it did not manage to close yesterday. That's the good news. Another piece of good news is the chart closed above 392.39, which was a previous gap and a point of resistance, and it closed at the highs of the day. Now we're looking for 396, which is the gap above. If that's beaten, we're looking back at 398. And today would be a bear trap. Therefore, I continue to say be careful here. We're not going to go short until the SPY closes the day below 385. And here is the daily chart for the continuous contract for the SPY. Again, closing at the highs of the day. Did not make it above 3,960. But that could be in the books tomorrow. The chart never violated 3,855. So the bears who went all in today betting against the stock market, watch out, you could be served a massive pie in the face tomorrow. On the other hand, are we going to go all in now, buying the SPY? Not really. You can buy calls here and there on the inflationary names, for example, but we're not going to feel comfortable in buying this chart until it closes above 4,102. Do you miss the rally if it happens between now and then? I didn't say that. You can play that via call options all you want. Energy, defensives, tech, whatever you think is right. But I'm talking about market participants as a whole. You're not going to see the options volume, for example, improving until we get a closing above 4,102. And we're waiting in the momentum indicators for the crossing to happen in the MACD, indicating the end of the negative bearish momentum and the start of a new bullish positive momentum. Here's the daily chart for the SPX, the cash index for the SPY. Again, another close below 4,000, but we're making higher lows. And when you look at the MACD indicator, it is just a matter of time before we have a crossing indicating positive momentum. That doesn't mean that the SPX is going to recapture all-time highs, but it means, at best, the bleeding is going to stop, and we might see consolidation going slightly higher, and in the average scenario, we could see a rally that takes us all the way back to 4,200. But things have to happen in the fundamentals arena to enable that rally to happen. Again, the technicals say this is a viable point for a rebound rally. We need the spark. The spark has to happen somewhere. A piece of news. Something. China reopens. The Fed says whatever. It doesn't matter what it is. When that spark happens, they're going to say it is the reason for the rally. But looking at the charts, you know that the negative momentum has already topped here. And whatever news they pin the rebound rally on, it was just the spark. That's all there is. And here's the Qs, 30 minutes chart. Bears, you must watch out here. A lot of you went all in today, shorting everything. Yet the Qs did not close below 285 yet. Number one. Number two, yes, we have a gap at around 292.22. That will be destination number one if we have a rebound tomorrow. Then we have 297.5. That will be destination number two, but we'll take it one day at a time. Now, until you take the lows and you close below the lows, which are around, let's say, 280, you don't have a shorting signal yet. And for more clarity, here is the daily chart for the continuous contract for the Qs. The number we're looking at is 11,689. Now, you can be more conservative and say 11,650. If we have a daily closing below that, then you got your confirmation signal. But for now, all what this is trapping more bears to initiate a short covering rally. Look at where the momentum indicators are. They're bottoming. All what we need is the spark. Whatever that spark is, it will blast this chart higher. We will have resistance number one at 12,207, and then we'll take it from there. But are we going to go all in buying calls? Not really, until we see the top of the reversal candle taken out. And that number is 12,594. If that happens, the bulls will feel more emboldened that we got a bottom for now, and we could have a summer rebound rally. Here's the IWM, the Russell 2000, 30 minutes chart. Again, we have a down day, gap down, but the chart made a higher low, number one. Number two, the chart closed above 174.22. Again, do you have a shorting signal for real? Of course not, because the lows at around 170 are not taken out yet. Do you go long for now? Not really. You need to see a little more. You need to see the gap being closed to 177.85 and the chart closing the day above that number, not below. That would be at least an encouraging sign that we might have a bottoming formation here to work out with. Moving on to the Dixie, the dollar index, it continues to go down and it lost 103 as support. So we have the conditions right now. The 10-year yield is cooling down. The Dixie is cooling down. We're seeing instances of short covering in individual names, but we're not seeing the participation of the retail crowd buying stocks, but most importantly, buying call options. Until that happens, the stock market is not going to sustain a rally. And for the retail crowd to start buying calls again, we need something in the fundamentals. We need something to change in the fundamentals, at least on temporary basis, to encourage the bulls to buy some call options. For now, the assumption is if the dollar continues to go down, we have 99.9 as support, and if it goes down there, that will be good for gold and many other commodities. But it's hard to bet against the US dollar with all of the tailwinds intact. So for now, we're assuming it is a pullback. We just don't know where the rebound in the Dixie will come from. If it comes from 99.9, that would be good enough for commodities or for gold to continue to move higher. Speaking of the devil, here it is, gold, above the Fibonacci retracement support and above the trend line again. We're seeing positive momentum in the MACD, so all signs are pointing out for more gains for gold, but a lot of folks want to wait for more confirmation. The next one would be gold closing above 1,895 as support. What about UK oil, Brent? From a 4 hours chart perspective, we have higher lows. That's good. We have static highs. The same resistance at around 14, 114, 115. If this formation persists, the assumption is we will see crude oil Brent passing the 114, 115 test. Then comes 120, and after that 140. So watch out here. We could see a summer rally in oil, which would be good for oil stocks, but not good for the picture of inflation, which means once again we will see more pain in the defensives, the transportation, etc. Here's the daily chart for the 10-year yield. Again, we're seeing the head and shoulder / the bear flag playing out. The assumption is 2.5 should be good as support, and this cool down in the 10-year yield should be good for the Nasdaq. But again, here comes the battle between technicals and fundamentals. The technicals were pointing out for a rally in the Nasdaq. Then came the fundamentals from Snapshot. The question is, will the market forget about the fundamentals in a day or two? If that is the case and the 10-year yield remains tamed, then we will see the Nasdaq moving higher again. Here's the TLT daily chart. The bull flag is playing out. We don't have any signal for a reversal or a topping in this bounce higher. So the assumption for now is we should be eyeing 125.12 or a reversal candle, which will mark the exit point for this trade. Here it is. The VIX 4 hours chart. What's going on here? Still consolidating. Look at the MACD indicator. It is moving back and forth between negative and positive, indicating that this could go either way. This could be a consolidation before a massive pop higher above 33 in the VIX, or it could be consolidation before we see a pullback all the way down to 24.29, and that would be good for the SPY. So for now, inconclusive in the VIX. What about the VXN, the VIX for the Nasdaq? So long as the trend line remains intact, you cannot really feel secure buying the Qs right now. On top of that, the MACD indicator, while it's negative right now, it could cross again, signaling positive momentum. So for now, we have to wait for the trend line to be broken, and that would be a good confirmation that the rebound will happen in the Nasdaq. Of course, you have to look for other confirmation signals, such as the resistance and support lines that we identified in the Qs chart. And then we have Apple, a daily chart. The good news is it closed above 138.79. The momentum indicators appear to be bottoming for now. They could go a lot lower if they want to, but the volume cooled down today. Could this be a signal that we have at least a short-term bottom in Apple? Well, you're not going to feel secure that that is the case unless we have 145 as support once again. But for days like today, the market is not giving us a clear signal whether to short or go long in a meaningful way. And it's only spinning out day trading opportunities. For example, on top, the UVXY, a representative of the VIX. Below is Apple, 3 minutes chart for both. The futures open gapping down, so the UVXY was blasting higher. Realistically speaking, you cannot really hop in and short that time because things were moving down quickly. But then the UVXY started to consolidate, and the support became 16.52. On the other hand, Apple also was consolidating below the resistance of 138.79. Once we saw the support in the UVXY being broken, that was the signal to buy calls on Apple. Or you can buy puts in the UVXY, whatever floats your boat. In this case, I bought calls for Apple, and you ride them all the way till the UVXY hits the support, which is closing the gap at 15.74. And that produced a decent call options trade. Not the best gain out there, not 1,000%, that's for sure, but a decent trade. A gain is a gain, doesn't matter what it is. And then we saw the UVXY rebounding from 15.74. It went back and forth, and it closed above that number, although with a massive down candle. So for now, it is inconclusive because had the UVXY closed below 15.74, that would have been a clear signal that we will see the Nasdaq rebounding tomorrow. But for now, they're keeping us guessing here by closing the UVXY above 15.74. But they gave you one positive signal for Apple by closing the day above 138.79. Moving on to the souffle, Tesla. This time we're using a weekly chart because once 700 was broken as support, that was a shorting signal because once 700 is broken as support, the algos get triggered right away, producing more selling. So we're now looking at support number 1, 539. Support number 2 would be 502.49. So again, 539.5. And then we have 502.49. Can Tesla rebound tomorrow, for example? Yes, it can. But the bulls are not going to feel the all clear until Tesla recaptures 700 as support once again. Either way, breaking 700 as support is an ominous signal indicating that even if Tesla recaptures 700 as support, it's going to break it again later on. So if you are trading options, specifically short-term options, and you bought puts on Tesla after 700 got broken, the advice is take your gains and wait in the sidelines. If Tesla fails to get to 700 again and it fails to rebound from this point on, you can always get back in the trade. But once you lose your profits, you can't get that back. Now, if you have longer expiration dates, you don't really care, because even if Tesla reclaims 700, that gives you an opportunity to place batch number 2 and batch number 3 of the trade. Moving on to tulips, BTC, nothing is going on here, still consolidating at around 30,000, asking for buyers. If the buyers are not going to show up, the flush down will happen. It is just a matter of when. So tulip enthusiasts, you better put your money where your mouth is and start buying now. And lastly, moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have durable goods. We also have Vice Zombie, Lael Braindead, making some comments, and of course the pre-recorded FOMC minutes. On the earnings calendar, we have Williams-Sonoma, Dix, and NVIDIA. With that, folks, I'm done here. This is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.
Ich glaube, ich habe gerade ein Déjà-vu. Das Licht, der Wald, als ob das alles schon mal passiert ist.
Ein Fehler an der Matrix.